We're up to 20 people, so there's going to be the odd straggler, but I'd like to continue on if we could. So, welcome to everybody. It's health and safety and trade credit event. It's good to see so many people on the call. So, I'm going to hand over first to Mike, who's going to cover off some health and safety for us. Thank you.
Thank you, Ian. Good morning, everyone. Thank you. First off, thanks to Ian and Claire for inviting me along. I would always attend, but thank you anyway for just giving me the opportunity to speak and give you a little brief overview of our health and safety landscape for 24-25 and into 26. So what I'm going to try and do is I'm going to try and share my presentation. And I've done this before, and last time it went totally wrong, so there should be no reason why it won't go wrong today. Oh, well, do you know, it didn't. There you go. That's a good thing.
Perfect. Oh, yeah. Well done, Mike.
I'm telling you, I'm doing all right. I'm doing all right. Second time this year, great, which is a bit of a disgrace because we usually teach online. So there we go. Anyway, so without further ado, so moving swiftly on then. So health and safety topics. Now, it's very common for me to just come along and give you some health and safety topics and just pull them out of my bag of health and safety topics that I'm looking at throughout the year. This time, I thought it'd be maybe a little bit more interesting if I tell you where we get them from, as opposed to just saying, well, this is that, and that's this, and that's that, and let's have a look at Lola, let's have a look at the pressure regulations. Just tell you where we get them from, which I think is a little bit. I think it'd be a bit better. I think there's a bit of benefit in that today. No health and safety professional comes into work and goes up to the boss and says, you know what, I think I'm going to start stripping down the asbestos on the roof. Let's have a look at that today. Let's have a look at my systems. They don't. There'll be a reason. There'll be a reason why. Everyone's got a reason for why they do things, and health and safety is no different. So what I thought I'd do is we'd just say where we get them from. Okay. So without further ado, then let me move this on a little bit. So, health and safety itself, there's a plethora of places where we would get health and safety from. There truly are, in the true sense of the word. There's a pile of places, and each company is different. So, depending whether it be an NGO, a non-government organisation, or it be the government, or it be an enforcement authority, it be the insurances, anything like that. Accidents, that's where we get our stuff from. But today I thought it'd be just interesting if we could, just for a moment, just to concentrate on 3 areas. So the areas that I would look at when I'm going forward and I'm looking at health and safety. So what I would do, what thing I would look at is there's 3 places that are my main areas that I would look at. First off is the health and safety executive, part of the health and safety executive plan. This one says 24-25. It should be 24-25 and 26 because it always leaks over into the year after. I would look at the government from the regulatory reform and growth. Obviously, the government is a main because they're the ones who decide where we're going. And then I would also look at health and safety incidents and prosecutions. Now, obviously, health and safety incidents, prosecutions relies very strongly on the organisation, even the sector. So I can't rely on it totally, but it does give me an indication of what's going on. In this particular instance, I'm going to ignore health and safety prosecutions just for a moment, because I don't think that's important to this particular session. I'm going to ignore the government. Not that we should ever ignore the government, but fundamentally just to say, okay, because at the moment there's a lot of flux and a lot of change out there. So what I want to concentrate on is the health and safety executive business plan. At the end of the day, it's going to be the health and safety executive that we see the most. If we're going to get ourselves into any sort of issues going forward, 99.9 times out of 100, it will be the health and safety executive. So I think in this case, it would be interesting just to look at the health and safety executive's plan. So if we look at their plan for 24-25, reaching it in 26 as it always does, the plan itself gives us an overall context of the plan. It gives us a financial outlook, and it gives us enabling activities, what they're going to do. It gives us their operational activities, and it gives us their strategies and objectives. Now, obviously, I've just not got enough time to start going through all that, so we'll forget the overall context. I'm sure we'll all understand what that's about. The financial outlook is interesting when we look at it because it tells us where they're getting their finances from, and there are certain things that we can look at when we look at their finances. For instance, I realise that they're getting just short of half of what they get from a finance point of view is coming in from is coming in from fee for intervention. So we know that they have their own commercial wing. Although I'm not trying to say, and it's only Mike Pearce saying this, of course, that fee for intervention is a commercial activity. Obviously, there is a good solid base behind it, but I just wanted to point that out. He tells us they're enabling activities and operational activities which have not really changed much, but it's beginning to reflect. So in this particular briefing session, I'd just like to concentrate on the strategy and objectives. When we look at the strategy and objectives, they give us 7 things that they're going to be looking at, 24, 25 and 26. These include, number 1, the objective to reduce work-related ill health, and we'll come back to that in a moment. They're going to be establishing a building safety regulator, which is to do more to Glenville and that horrific tragedy. They're going to be reforming chemical regulatory regimes. They're going to be looking at regulate the gas safety register. They will be enabling innovative safety through net zero. There's a link between net zero and safety. And they're going to be maintaining a safety record. Last but not least, they're going to be looking at increased trust. Now, please remember, these are only just brief sections of a whole whole program. So I've not gone into anything sort of major details. So when they look at reduced work-related ill health, they're going to be focusing on several key areas. These are going to be mental health and stress, which I think is a big do. I mean, obviously, it's something I've been into for many years. As a stress counsellor myself, I realised that stress is an issue, as is all mental health, and certainly mental health at work, which is it's important. I mean, 1 in 4 of the population of Great Britain will suffer from mental health at one stage in their life. However, having said that, there is an issue that when we look at it straight away, we realise there's a problem with that. And why? I think because it's fundamentally, I could go to the doctors today, say, look, I feel a bit stressed, my heart's racing, I'm not sleeping well, I think I'm suffering from stress, and with all due respect to any medical professional, they will probably give me a sick note for 7 days, possibly 14 days, depending on where I am. Now, please don't misunderstand. I'm not trying to degrade the triage system for a GP. I'm just saying that's what it is. He doesn't know you. She doesn't know you. They've not got time for this. They've got 10 minutes in which you get in, you get out, and thanks very much. So what the HSE are trying to do is build an evidence base for mental illness and say, right, well, this is what we class as mental illness. This is what we class. And when we say mental illness, we have to be very careful. That is a very derogatory phrase. And a lot of people can get very concerned when you talk about mental health, as though it's some sort of, well, we'll just leave it at that, like it's some sort of plague you've just given them. That's not really what it means. We all suffer from some sort of mental health at some stage. So once they've got all this together, they're then planning to deliver some sort of summit to have a look at this and get this out there to find out what they got get this out to the stakeholders. So going forward then, one thing they are going to look at when they look at work-related ill health, they're also going to be having targeted risks. So these will include asbestos, MSDs or musculoskeletal disorders. They're going to be looking at noise, respiratory, Legionella, lead poisoning and asphyxiation. So I already know from day one, these are the things, if someone comes on site today, if I get an inspector comes on site today, they're going to be looking at one of them. That's what they're going to be looking at. So as an health and safety professional, I'll make sure I've got these boxes ticked, so I know exactly what I'm doing. They're going to target all these together, because if you look at all them, it's health. So they're going to target all these together. So they're going to work with the Department of Work and Pensions. They're going to work with the Department of Health and Social Care on work health, and that's when all that will be delivered on the summit. Now I've not got a timescale when this summit will be, but I'm sure we'll be able to pass that along when it finally arrives. So just to move on a little bit, so they're going to establish a building safety regulator. So there's going to be a new scheme that will go live. There'll be a regulatory regime to unoccupied high-rise buildings. They'll be building assessment certifications. So you can see what they're doing. They're actually following on from Glenville. They're actually going to start getting a grip of these high-rise businesses, and not to mention the fact, when I say that, I meant to say high-risk businesses, high-rise buildings are high risk, but that's not just high-rise buildings. There are other buildings that they're looking at the same time. Next thing they're going to be looking at over the next year or so is to reform the chemical regulatory regimes. Now, allow me to explain what I mean by that. I would say a good 80% of the chemical regulations that we've been working to for the last 20 years, at least, have come out of Europe. It's been satisfactory. There's been no issues with it, although there have been there's a few of us would say it was a bit red tape heavy, but we have what we have. However, when we've withdrawn from Europe, it meant that there were certain parts of that were no longer fit for purpose for us. So that would be things like REACH. REACH stands for the Registration, Evaluation and Authorization of Chemicals, which means that there's certain chemicals that have to be registered. If we're using certain chemicals, we have to get permission for it. Things like amyl acetate, any of the trichoethylenes, you have to get permission. You can't just use them. But we don't have to get permission from Europe anymore because we're not part of Europe. So this is where the government are saying, well, it's not really fit for purpose anymore. And as it was retained under EU Law Act of 2023. So therefore, the intention is to revisit some of these chemical regulatory regimes and look at them slightly different. For instance, there is an intention later on next year to deliver the UK REACH work programme, which is kind of in support of our withdrawing from Europe, because the REACH at the moment was an EU directive. So therefore, it's going to be revisited. I guess the regulatory gas safety register, well, we've had that for many years, of course. However, I was quite surprised to hear on some of the reading I was doing last week that they don't actually carry out competence checks. Believe it or not, they don't have competence checks on safety engineers. Not for domestic anyway. So what they tend to do is to maintain the register for competent persons and operatives. They intend to carry out domestic safety engineer competence checks, basically just turn up on site and say, right, tell me what you're doing, and then monitor complaints and risk-based with regards to risk-based inspections. So they're going to pay a bit more attention with gas safety going forward. So moving swiftly on now, oh my God, that's a word and a half. Innovative. That sounds about right. Innovative safety net zero programs, and obviously, as nowadays, more and more are striving for net zero. At Murray Plate, we are. I myself drive an electric car for my sins, so we can see the way the workplace is going. So they're going to support net zero programs, Department of Energy Security and net zero, by the Clean Heat program. They're going to amend legislation to offshore hydrogen. They're going to review health and safety executive activities as statutory consultees to the new net zero technologies, deliver investigations for EV charging and aging assets, and develop research capabilities for liquid hydrogen, which is part of their place at the HSE they have over at I've got the name of the place now. You have to excuse my ignorance. I've kind of gone blank there for a moment. I had a senior moment. Buxton, over at Buxton, they do development. They have a research laboratory there. They're going to start developing it from there. So you can now begin to see that this new net zero is seeking into the HSE's work activities. So obviously, we have reached a good safety record in the UK, says Michael, touch wood, but we want to maintain it. I mean, I actually think it was a slight increase last year. Well, it was a slight, I think it was only by a fatality, but please don't misunderstand. A fatality is a fatality at the end of the day. So what they intend to do is proportionate enforcement. They are proactively regulatory work, stakeholder engagement, development of standards and guidance. They want to communicate their campaigns, implement revised regulatory processes, review risk-based decision-making models for non-fatal incidents, not for fatal incidents. That's a completely different thing altogether. And they have fewer but more impactful investigations, which kind of raised an eyebrow when I read that statement when it was published by the HSE, and deliver major hazard interventions. So it's kind of a double-edged sword. One side they want to say, well, we're trying to be fairer and have fewer investigations, but then turn around and say, yeah, but they're going to be more impactful, and we're going to be delivering major hazard interventions. So they're going to be looking for more. So fewer, but they're going to be looking for more. So that's something to keep in the back of our minds going forward, anyway, which I think is really important. So increased trust. Now, when I first read this, I generally thought, well, perhaps you mean increased trust with the HSE, because I can, for every person that says, oh, they're great, the HSE, I can give you 4 that say, no, they're not. They're a bit of a pain at the moment. However, they are necessary, whether we like it or we don't. So as a consequence, I don't believe that's what they meant. I think it genuinely mean increased trust in the workplace between, in a multi-directional, so from directorship down. And I also mean between departments and intersections as well, so from the HSE across to across the workforce. So moving on. So to bring this towards the end, just allow me to give you some of the key takeaways for occupational safety and health and environment in 2025. I guess one of the key takeaways is 2025 brings a dynamic and evolving landscape for OHS management in the UK, with a move towards an holistic approach, integrating various factors. So I think that's going that way for some time. There is a clear and increasing emphasis on mental health and well-being as a critical component of workplace safety, with a greater employer responsibility for support. And I think that was a kind of a very significant change. A lot of people say, a lot of companies that I speak to anyway, say that, yeah, well, we're offering support. We have mental health first aiders, which is not support. Mental health first aid is after the event. It's already happened. It's already happened when that happens. So basically, we're kind of repairing something that's already broken. When we see inspectors visiting a site, they now want to know, well, what have you done about first aid? Where was your briefing sessions? What have you done to stop it in the first place? So that's what they say when they look at this proactive as opposed to reactive. Environmental sustainability is increasingly integrated into occupational safety practices, with businesses expected to protect workers to minimise environmental impact. Regulatory scrutiny and environmental compliance continues as normal. The Health and Safety Executive and other regulators are undergoing regulatory reform in support of economic growth while maintaining high standards, and this is the change from Europe to the UK standard. HSE will initiate work in 2025 to consult on potential changes to RIDA. There are some changes that they want to make, and I think that is linked very closely into mental health. Certainly the reporting process and the definitions of occupational disease and dangerous occurrences, that's where it's going to be focusing on. They're going to review some specific regulations like the pressure system safety regulations and LOLA, lifting operations and lifting equipment regulations. There will also be some regulatory change to that, although they've not actually said what's still in the discussion stage. There is a continued focus on high-risk industries and specific hazards, including targeted inspections based on incident data and sectorial trends. Occupational lung disease from chest, chemicals, and asbestos remain of paramount concern, and that's where it came from. The plan where they were looking at ill health. Workplace injuries continues to be a key focus, and common incidents like slips, trips, and falls, and manual handling under scrutiny, especially in high hazard environments. Technologies and AI integration presents both new risks, cyber threats and that type of thing, and machine interaction hazards, and opportunities to enhance safety, such as wearable tech, VR and AR, for training, AI risks and predictions. Now, just before I move on and bring this to a close, allow me to explain. I personally don't have any problems with AI. I think AI is a good thing for us, but however, it has to be used, and it has to be used in the right scenario. Just getting AI to write as a risk assessment isn't the way it's done. You've still got to put all the information in, and no matter what we think, we can't. That will not take the human element out of the actual risk itself and the management process. I just thought I'd mention it, but as I say, I personally don't have a problem with AI in any way. Ensuring safety and support from a diverse workforce, including vulnerable groups, is strongly emphasised. And last but not least, fire safety remains top priority, driven by the Grenfell inquiry and increasing attention emerging risks like lithium-ion batteries. So So I think I've got to the end of that short presentation, and my profoundest apologies for going battering through it like I don't know, like a hamster on speed. But I've just got so much to cover, and I just thought it'd be a good idea if I showed you where we'd got some of this stuff from. So when your safety practitioners come to you and say, "Oh, listen, I think we need to look at asbestos," you'll think, "Oh, yeah, I do remember that. Yeah, I remember where we'll know where he's got, where he or she, of course, has got that from." So without any further ado, has anyone got any questions? Excellent. It's like shelling peas, this. I've nailed it. So without
sorry, Mike, I do have a couple of questions.
Oh, sorry, excuse me. I was going to press the next button,
so
please.
I was waiting for my turn, so I thought I'd give everybody else a chance. There's a couple of things. You did mention fewer but more impactful. Are they, is that an oxymoron?
Yes. I think
it is.
So. I mean, I genuinely think so. I mean, I can't read the mind of what they're saying, but because this is obviously a directive handed down to local inspectorates. But at the end of the day, it does seem a bit weird. I mean, in the nicest possible terms, but it genuinely does. You know, we're going to have a few of them, but when I come by, Christ, I'm going to inspect you. Thinking, well, I'd rather you didn't turn up for that.
But does it mean that actually what they're going to do is they're going to hit the people who are doing it wrong harder, which will then get publicised? So I've got fewer cases, but what I'm telling people is I'm sending the message. Is that how you're reading that? Or
I would say that was a fair assessment. I'll be perfectly honest with you. The things I've got so far from my interactions with the HSEs, with the HSE, was the fact is that, let's just take, for instance, mental health. If we've already said, oh, we do some mental health training and we have a mental health risk assessment and we have mental health first aiders, they're quite happy then to think, well, they've already got that. So they're quite happy to move on. However, if you find out that you've not got any of that, then watch them pay a bit more attention. Watch them dig deeper to find out. And I don't mean dig as in I'm looking for trouble. I'm just saying digging into to explore it, to explore a bit. I mean, good luck to them. I mean, that's what they're there for. So to make sure. But I did take that from it. I got from it that they won't be doing as many, but dear God, they will be digging down. They will be digging down when they find something.
Yeah. Okay. Sorry. It's all right. Somebody wanted me. No. And that there was last year when we did this presentation, we were talking about metalworking fluids.
Yep.
Have we got any feedback now from the HSE as to what they found, whether people are doing the job correctly? I mean, obviously that's the sector that we're in.
Yeah, the feedback was that people are doing the job correctly. However, some of the tests weren't correct. They were farming a lot of tests out to a third party, and if you look at the guidance on the health and safety website, they wasn't following it exactly, believing that when you farm that out to a third person, that they're going to get that you're going to tick a box saying I've done it all right, which is not necessarily correct. Please don't misunderstand when I say that, though. I don't want to cast aspersions on anyone's work. There is a lot of chemical test companies out there that do an excellent job. But yeah, I think the vast majority was, they were doing all right, but they were missing some crucial tests. They were missing. I think adding bacteria was one. I think they actually mentioned at the time.
Right, thank you for that, Mike. Does anybody else have any other questions for Mike? Anybody? No? Right, Mike, thank you very much. That was
my pleasure.
Very insightful.
Thank you. Just for everyone concerned, I'm going to be sending a copy of this to Claire with my references on it. So if you'd ever wanted to check up to make sure I'm not having a go at anyone or I'm making things up, then please. I'm sure Claire will more than happy to send you a copy with all the relevant references on. And not to mention the fact, if you have any questions later on, you think, oh, shit, I should have asked him that, then please feel free to. I'm sure Claire wouldn't mind if you send her, then she'll send it me, and I'm more than happy to respond. Thank you very much for your time. Thank you.
You're an absolute star. Thank you very much.
Thanks, Mike.
Are you going to stop sharing your screen and then? Fantastic.
He's nailed it. The lad.
You're an absolute star. Thank you, Mike.
Thank you very much.
Right. Next over to Shannon Murphy to talk about the economy and trade credit, I believe, Shannon. Is that correct?
That's correct. Thank you. Yes. Yep. I'll see if I can share my
presentation, and I tried to get the balance right as well, not too much doom and gloom. And yeah, thank you for giving me the opportunity as well this morning for presenting. Right, okay, so I can get the technical part done. Okay. Don't know if everybody can see that.
We can. Thank you.
Good. That's a start. Okay. Yeah, our Teams was updating yesterday, and it's changed the format slightly. So where you used to click, it all looks different now. So okay. Good morning, everybody. And I'm just going to give an overview of how we see it in terms of the economy. Talk about insolvencies, and then finish on how we see the steel market at the moment, and sort of claims and general risk appetite. Okay. Skip the. Come on to the first slide. Okay, so the UK economy very much contending with fairly weak growth at the moment, and certainly higher than we would like in terms of inflation. Various political sort of commentators, economists have taken a fairly mixed view of the UK economy. Sort of GDP growth ranging anything from 0.5 up to 1.2% this year. Admittedly, forecasts sort of change fairly rapidly. We've had the sort of a UK-US trade deal of sorts, and sort of much higher than feared tariffs that have been reduced. So that's has a big play on our forecasts, and it's very, very, very changeable. So I would imagine some of the forecasts that we've seen. I know the International Monetary Fund, their recent forecasts on the UK economy were fairly sort of doom and gloom, but I think at the time they were factoring in the much higher tariffs than we're likely to see, but they still point very much to high inflation, which remains fairly sticky, higher energy costs, and rising gilt yields as well, with the sort of the government debt. We've also got some 700,000 British households that face a jump in their mortgage costs when they come off fixed rate deals this year, and I think generally the sort of the trading environment for a lot of companies, they're looking at rising tax burden, which certainly poses downside risks to UK economic growth this year. Although households do have good saving buffers, and if we see stronger public spending, that should support some pick up in economic performance this year. And I'll touch on the tariffs when I come to one of my later slides. Interest rates also still high, but we have seen a slight reduction in interest rates as well, which will help in terms of companies' borrowing costs. I think certainly the Chancellor faces fairly significant challenges to adhere to her own fiscal rules while sort of pursuing a growth agenda. The fiscal headroom remains very tight, with the risk of a downgrade to forecasts being quite high. I know the central bank's chief economist said he was still worried about stubbornly high inflation, which remains above target, and that will likely mean that interest rates will need to stay higher than expected. But we did see a cut in the bank rate from 4.5% to 4.25% last week, and that's the fourth reduction that we've seen since August. And we're likely to see two more rate reductions this year, which by the end of the year could take us down to 3.75%. But the Monetary Policy Committee were very mixed in their view of whether we should have taken the rate down slightly or kept it where it was because of inflation. But the rate reduction got the vote in the end. But it's unlikely that we'll see our 2% inflation rate target met, and it's likely that interest rates will stay higher than ideal for now. Next slide. This is hot off the press. This is from this morning. Given the news yesterday that the UK economy actually grew by 0.7% in Q1 this year. And that was the fastest pace that we've seen in a year, and that was above the 0.6% that was very much forecast by most economists. And certainly in March we had a 0.2% growth, where I think most forecasters were saying that there wouldn't be any growth. So obviously up to March, that's very much based on data compiled before Trump's so-called Liberation Day on the 2nd of April, and whatever that's going to bring next. But that's certainly was a positive in terms of the economic figures that came out this morning. Insolvencies, they have started to come down, but I think probably fair to say, yes, we're not holding our breath just yet. Number of insolvencies was slightly down for Q1 this year, and over the last 12 months they've been slightly lower than for last year than they were in 2023, where we saw a 30-year high in terms of the annual numbers. We've seen more of an uptick in creditors' voluntary liquidations. There was also a 17% increase in administration activity, and that was 30% higher in March than the same period last year. I think overall what we're seeing from companies is the impact of higher costs, much lower business confidence, and low growth prospects. And certainly for many businesses, the tax burden remains very high. I think from our own view, HMRC winding up petitions, there's always a red flag for us if people are on time to pay initiatives with HMRC, and if you miss a payment, they are much more aggressive. I think because a lot of money was lost during COVID and the bounce back loans, and a lot of that money was never recovered. So they seem to be fast tracking petitions and compulsory liquidations. Say for February this year, are up by 49%. So there's a growing enforcement action being taken by creditors, and particularly HMRC. The vulnerable sectors for us being construction, retail, and hospitality. But with HMRC, if there is a winding up petition, that's fast tracked. So often there's no statutory demand. The petition gets served, and if other creditors will piggyback on that petition, the chances are it won't get removed. So that's something to be very wary of when you're trading with companies, and that's for us is a major red flag at the moment in terms of HMRC. If there are repayment plans in place of HMRC, they must really ensure that those payments get paid, and they don't miss any, because they don't appear to be open to renegotiating on those. Okay. Global. Carry on with insolvencies. This is Q1 globally by sector and by size. So there was a high number of cases in Q1 this year, which still surpassing the pre-pandemic average level, and sort of marking the fourth highest quarterly total since the start of our monitoring, which started back in 2015 in terms of global insolvencies. A lot depends. in terms of forecasting. If we see a full-fledged trade war, that could push global insolvencies higher by as much as up to 8% this year. So geopolitics will be a major factor in terms of turbulence, and obviously we have the ongoing conflict of Russia, Ukraine, the Middle East, so tensions in the South China Sea, and political uncertainties in Taiwan. So there's a lot going on at the moment, but I think some of the upside certainly could be Europe benefiting from increased defence spending, and that will have a positive impact, although obviously limited to a small number of sectors. But there will be a surge in European defence spending, and that provides opportunities and challenges. And if funds are directed towards domestic production, technological development and supply chain expansion, there will be capacity constraints in European defence industries, but certainly that provides some very good potential there. And we've seen that before, where big sustained defence investment has driven strong industrial growth. We saw that in France and Germany during the Cold War. And increased domestic procurement could, revitalise aerospace, heavy machinery, metals, and electronics. So there's some good potential there. Construction would also benefit from infrastructure spending and projects such as base expansions, airfield upgrades, naval port modernizations. So there's a lot that could happen there that could prove a major positive. Okay. It is always trying to get the right balance in terms of sort of economic outlook. This was one of the extracts from one of the slides that our French economist presented recently, which was quite upbeat actually in terms of the UK. Titled "Short-Term Pain, Medium-Term Gain." So I think some of the positives they took out was easier process in terms of getting planning permission, reintroduction of the compulsory population-based housing targets for local planning authorities, certainly simplifying the process for getting consent for significant infrastructure schemes such as like power stations. So increased infrastructure spending, tackling of NHS backlogs, unlocking of private sector pension assets. So there's a lot going on there, but obviously it's all been paid for by increases in taxes, and the sort of burden of that has fallen on companies quite heavily. And so there is some short-term pain, but let's very much hope that we do see some upside and some potential, some positive growth going forward. So the outlook is expected to brighten from second period this year. I think businesses have been very pessimistic because they're having to take a lot of additional cost, a lot of the tax burden on. That's had a big impact, and forecasting has been very difficult at the moment. And I think there's been a kind of a pause in terms of investment, a pause in terms of taking on new employees, very much a wait and see how the economy develops, and particularly what happens globally as well with tariffs. And we've seen cases where some capex has been put on hold just to see what happens next. So it is very, very difficult for companies to do any forecast at the moment, and it's quite common that when they do give us a set of forecasts, they will be revised 2 or 3 times, sometimes within the quarter. I think some tend to take more of a much more downbeat outlook, and then they hope to be in a position where they can revise upwards So it's I think it's a very unpredictable times, but I think you hear sometimes normality, and what is normality now? We've had Brexit, we've had a pandemic, we've had a war in Europe. I think I remember presenting at one of these NASS events where the very day I was presenting, and as I was actually making the presentation, the Russia invaded Ukraine, and I remember thinking, okay, a lot of these forecasts are going to go out the window now, and particularly what it did to energy costs as well afterwards. So and with Trump at the moment, with zigzagging all the time, it's there's no predictability at all. In terms of the UK, I mean, we've always had a very balanced trade relationship with the US, which I think we felt always made us less of a central target. Our sort of closely balanced goods trading relationship with the US, it's, where we have a surplus, it's a very small one of about 2.1 billion. So it's one of the narrowest surpluses that we've had for many years. So I think it always gave us the chance that we wouldn't be quite so heavily impacted by tariffs, which has proved to be the point. What we have seen this year, though, certainly from the profits warnings that were issued by UK listed companies, tariffs did have a big impact, and of the 26 profits warnings that we saw in April, 13 of the profits warnings did cite the impact of tariffs, and this was anything from sort of the electronics companies like TTT Electronics, shipbroking giant Clarksons, even the Peppa Pig toy maker Character Group. They withdrew their profit guidance amid the uncertainty caused by the tariffs. And what we have seen is certainly the velocity in terms of the zigzags of the Trump mayhem, which has been quite remarkable, really. And just over a month after Liberation Day, thankfully the core tariff conflict between the US and China is far less toxic now, and they seem to have reached an accord which reduces the extra tariffs imposed on China this year to 30% from what could have been 145%, and China has cut the US tariffs from 125% down to 10%. I mean, admittedly, that's for 90 days. So what happens in over 90 days time? But it's almost a kind of a total reset for now. And Trump. From the Trump took a kind of a victory lap on this, and he had masterminded this total reset with China, where China were saying that for them it was a great victory. So I think the truth was that both sides, although it could have been a protracted fight between them, I think the temporary deal came about probably more quickly and easily than we expected, and perhaps it suggests that both sides were enduring much more economic pain than they had said. In terms of very much a mixed reaction on the UK-US trade deal. I mean, we've seen the tariffs on cars exported to the US will be reduced from 27.5% down to 10%, and this applies to the quota of up to 100,000 cars, which is almost the total that the UK exported to the US last year. I think we came in at 102,000. And then the 25% tariff on UK steel and aluminium to the US is going to be scrapped. But I think there's still a lot of uncertainty in terms of how these are going to be imposed, and it's not clear at all. There's still lots of questions in terms of the conditions that need to be met in order to address Washington's concerns about squeezing China out of the supply chain for strategically vital minerals. And then you're hearing from the automotive industry that the tariffs haven't been reduced yet, so they're still up at 25%. and it's difficult really to afford to assess the full impact. And I think we need to understand the supply chain conditions that need to be met and how these quotas will be defined and when they would take effect. And yeah, it's certainly not clear at all at the moment. So UK construction had fallen in each of the first 3 months of this year. The PMI stats were showing a decline. I think although it was slightly better in February, output was still shrinking, new orders are falling, and rising costs have been hitting business confidence. And generally, we're seeing the S&P Global UK construction PMI. Globally, it rose slightly to 46.6% in April, but it's still a month of contraction overall. And I think certainly probably echoes what we're seeing in the UK, business uncertainty, which has delayed new projects, and that's caused a drop in new orders and staffing levels. Civil engineering has been the weakest sector, while residential construction has showed more resilience. Commercial work was down sharply amid growing concerns about the UK economic outlook, and purchasing activity dropped at its fastest rate for nearly 5 years, although supplier delivery times improved. So it's a bit of a mixed messages really. I think job cuts continue but have slowed slightly, but business confidence is still sort of fairly lacking. But I think some firms certainly still see hope in renewable energy projects. The fact that interest rates have come down slightly, and hopefully we'll start to see improved economic activity in some of those projects that will start to progress now. North Sea oil and gas indecision. We did see the Brent crude prices at one stage had dropped below $60 a barrel in April, and that was really at the peak of the tariff turmoil. They're still comfortably above the estimated cash flow break-even price, but I think certainly from North Sea investment, a lot of the production of oil and gas kind of peaked at the turn of the millennium. And for operators in the North Sea, they have this sort of energy profits levy, this EPL, which was first introduced back in May 22, and it's since been extended and raised multiple times. So the headline tax rate on oil and gas producers now stands at around 78%, once all the various levies are totted up. And the North Sea is a fairly mature hydrocarbon basin. It's where there are newly discovered reserves. They're usually located in places where the operating costs can be fairly high. And I think certainly with all the sort of the levies, it's a very expensive place to operate. But surprisingly, despite all the doomsters, the UK North Sea Transition Authority, they said that actually in last year investment came in at nearly 6 billion, which was more than 50% above what was predicted. So that was good to see. And although for this year spending is expected to cool a bit to about 4.8 billion, that's still miles ahead of some of the previous projections. So although green goals have been speeding up, and Ofgem sort of fast tracked about $5 billion US dollars in grid infrastructure to keep up with all these clean energy projects, and demand will keep surging because of the artificial intelligence, all the data centers and air conditioning. But even the cleanest grids in the world need backup, And right now, it's probably fair to say that oil and gas are still doing a lot of the heavy lifting in this area. Car production. So I think that certainly the announcement on the tariffs was came as a huge relief to the industry, and the fact that we can export up to 100,000 cars a year to the US at a much lower tariff. It's still worse than before, but that seems to be the deal with Trump, that he gives you the very worst case scenario, and when he comes back with a revised deal, even though it's worse than what you had in the first place, you still kind of feel like it's a minor victory. The OEMs are kind of quite mixed on this, and I know JLR was saying that they very much warmly welcomed the deal, which secures greater certainty for them in the sector, and it will help sustain jobs. There's about 250,000 jobs, and this was vital to the UK's economic prosperity. So they very much put a positive on this. But it's certainly the agreement does provide some form of relief. It's considerably better than it could have been, but it does put a cap on our lower tariff exports to the US, and you hope that's a deal, and we have a clearer in terms of how it's going to operate going forward. And I think that's what a lot of companies are lacking from some of these recent announcements is complete clarity in terms of how it works, because certainly the reduction in the tariffs to the new 10% level hasn't taken immediate effect, and we've seen also some announcements from the likes of Nissan that said that they were looking at cutting 11,000 jobs in addition to some of the previous cuts of about 9,000 that were announced, and closing 17 plants. So I don't know yet what that means in terms of Sunderland and whether that would be affected. So yeah, there's some positives, but there's certainly some big areas of concern as well, and I think we do need clarity in terms of how the tariffs are going to be imposed. Overall and globally, that's 4 years in a row of below 3% economic growth. I think a lot of it was because of trade tensions, notably with this is what's causing the headwinds really, and we're expecting that Europe should see GDP growth improving from 1.1% to 1.6% next year, and that's despite headwinds from trade frictions, but they're going to see benefits from as just mentioned earlier, the heightened defence spending and infrastructure investments, and certainly Germany is expected to lead the recovery in this area, with growth reaching up to 1.7% next year. I can't help thinking that Europe could be next in Trump's crosshairs. I think he's already made comments that they're far nastier than China in terms of their dealings with the US. So I think they may have some pain to come still, but let's wait and see. What have we seen in terms of response to tariffs? Certainly governments and trading blocs are adopting a multi-pronged approach, and this in some cases includes retaliatory measures such as reciprocal tariffs or fiscal stimulus programs, perhaps diversifying their imports and drafting bilateral deals. Certain emerging markets such as Vietnam, India, Israel, Thailand, they're seeking trade agreements, they're cutting existing tariffs or increasing imports. In short, what they're trying to do is offer the US more incentives to try and deepen their relationships in exchange for more favourable import terms. And then countries that do have high export dependency on the US, such as Cambodia, Taiwan, South Korea, Mexico, Colombia, they're very keen to protect their markets for their goods, looking to negotiate and commit to buying more US products and increasing investments in the US where possible. Where certainly the uncertainty has been very high, has caused capital expenditure to be lower, and companies taking a pause in terms of investments. And we've seen, in terms of shipping data, we did notice that US companies have been stockpiling goods ahead of tariffs. So they've stockpiled goods that have been estimated to cover up to 6 months worth of demand, and that's been especially in like retail goods and consumer electronics. So they've been buying ahead there. So it's something that's been watched very closely, obviously, and it's likely that forecasts will need to be revised in line with what happens next in terms of Trump and tariffs. Inflation, it's the inflation numbers from the US actually were actually not as high now, and the US inflation was slightly down at 2.3% from 2.4% in March. So the slowdown in inflation could be temporary, a temporary respite, until the widespread duties imposed begin to push up prices again in many categories. And certainly economists have forecast that inflation could reverse its recent decline and probably reach 3% or higher by the end of the year. Something to touch on was our sector risk methodology. So when everything gets graded, where buyers are graded 1 to 10, sectors are graded from green, yellow, amber, red, countries are graded, and a lot of what feeds the grading, certainly when it comes to our sector grading, it's dealt with on a quarterly basis, and we assess the risk of non-payment by companies across 18 sectors, and that analysis would be conducted across sort of 70 countries around the world, and it's very much measured on a 4-level scale. So it looks at from low to high, and we look at we take a forward-looking evaluation of 4 key determinants, and that would be demand, profitability, liquidity, and the overall business environment. So when we're looking at demand, we're looking at turnovers based on organic growth. We're looking at obviously fundamentals like price competition of the sector, profitability. We're looking at margins, depending on the evolution of prices in raw materials, labour costs, fluctuations in supply and demand. Liquidity, very much not just looking at the cash positions but more the sort of the financing risks based on access to financing and payment performance. And then we look at the business environment. Apologies for the dog. I think the postman's arrived, so if you can hear some barking, it's and then we look at the business environment. So we look at sort of technological innovations, new government subsidies and changes. In anything that changes could change the legal framework and can alter business models and company strategies, and all that internal data and hard data is all forms part of our assessment when we set our quarterly risk ratings. I mean, at the moment we have metals as a sensitive sector. It's not to say that it impacts our underwriting in terms of we look at the company on its own merits as well, of course, and look at their own financials, and I'll come on to that in a moment in terms of our assessment. But our sector risk ratings also form an important part of our overall underwriting strategy when it comes to looking at our sort of overall risk appetite and the approach that we take. Manual underwriting, a lot of lower level now is underwritten by the auto systems, but manual underwriting key for us, and particularly in this sector, would always be the ownership management strategy. And I think because of the regular dialogue that we have with companies, particularly with NASS members, and their track record and their experience, that would have a heavy weighting on our grade. And obviously we look at any change in ownership as well, and the track record of the new managements that have come in. And then no surprises, revenue, profitability, liquidity, financial leverage, covenants are obviously important, whether a company's remains covenant compliant, clean auditors reports. We would always look at the high customer and high supplier dependency. Overall, looking at the forecasts and outlook, order book status where it's relevant, and particularly in construction, that's something that we always like to view. And then the economic, regulatory, and geopolitical environment, which could be less so for some companies. For us at the moment, we haven't had any severity claims in metals for the last few years. The green is the metals loss ratio, which has been tracking very steady. Construction as well, we've had you get a few blips, like the ISG failure last year, but on the whole, it's won't ever say it's under control, because you never know what's around the corner. But I think certainly key for us is the great work that takes place with the analysts, where they're having very regular dialogue with buyers, updating our database of updated financials, looking at the funding details, the covenants, and often taking a much closer review, certainly where there's been changes in ownership. We've seen a little bit more of that recently in the metals sector, and that means that we're ideally, where there has been a change in management or ownership, and we have a sizable exposure, we would always look to meet fairly quickly and take a fresh appraisal on the new structure, because obviously that would typically mean as well, if there's been a change in ownership, there's often a lot more debt in the business as well, so we need to understand that more clearly. We avoided severity claims. We could have had a couple last year with Ireland Steel and Atlantic. So if we'd had been running the sort of levels of exposure that we'd had historically, and then yes, we would have had some sizable severity claims there. We did have a couple in machinery and equipment of all sectors, so that loss ratio rose quite considerably on the back of Folkestone Fixings and Troy, which were two failures that we had, where one was a secondary buyout, and I think secondary buyout, they paid the top of the market price just before the market took a major decline, and it was just very much a sector that benefited massively during the pandemic, and when people couldn't travel and everyone was going DIY crazy and power tools flying off the shelves, and they almost had a sort of a 12-18 month Christmas period for them. And then the market took quite a sharp deterioration. I think there was just a lot of acquisitions, a lot of debt taken on. Private equity went into that market quite aggressively as well, and basically gave companies unsustainable debt burdens, particularly when the market takes a major decline. And Troy was one we saw failed for a number of reasons, but what didn't help was a winding up petition by HMRC that other creditors piggybacked on, and they just could not get that petition removed in time, had their bank accounts frozen, and it was game over very quickly. But this is a sector where credit insurance has a very high penetration. I think there's not many NASS members, not many players in this market that don't credit insure. And what it does give us is all the credit insurers, we get a good level of visibility. I'll just move on to the next slide. Our own view is, yes, we continue to give very strong support for the sector. helped very much by the regular face-to-face meetings and telephone buyer meetings. And where we do get changes in terms of ownership, it's very important for us to understand the debt structure and the covenants and the funding behind that, and the capability and experience of the management team. We do conduct deadwood reviews, so this is important for us. We sometimes have exposures that are actually higher than the company's total trade creditors, so we know there's a lot of deadwood there, and having the dialogue with companies helps us tidy up exposure to ensure we have the cover allocated appropriately. And we appreciate the openness of companies in this sector. It helps us, where they're proactive in terms of supplying information, and it means that we can get cover to the right suppliers where it's needed. And if we can't satisfy demands or write the cover that's required, I'm always happy to be contacted to explain why and talk about that in more detail. Our approval levels are kind of running up around the 75% level, so it always will depend on the grade of the buyer and the latest information that we hold. But our approval levels have been very stable and have been very supportive. And what we did have last year as well, we had a change in our internal structure, where the analysts before were postcode based, so they had their geographical patch, and they would visit companies within their patch, and then they're more aligned to the underwriting teams now, so they're trade sector based now, which means they might have a lot more travelling to do, but it's very much more aligned with the underwriting teams. And I think for us it's been a huge positive, a real benefit. And then we have the auto grading, which is very much derived from sort of hundreds of sort of algorithms, and there's been a lot of investment in machine learning. So you want all the heavy lifting to be done at a lower end. So what you're assessing in terms of making manual underwriting decisions is based on the more borderline, the trickier cases, the higher limits, and all the lower level stuff is being taken care of by the auto system. Yeah, I've lost track of time, so apologies if I overran. And thank you very much for your time, and I'd welcome any questions. Thank you very much.
Does anybody have any questions for Shannon? I think that was very informative, Shannon. So I suppose the big question is, you say insolvencies are down, but I know we flagged it up last year. HMRC are taking a much tighter line with people now. Is that, do you see that continuing on?
I do, Ian, very much.
Yeah.
Very much so, yes. Where we look at management accounts, or part of our questioning when we meet companies is always their position with HMRC, and do they have any time to pay initiatives or anything in place. And it's always a potential red flag. They've really got to be very careful how they handle that relationship and ensure that they don't miss any payments, because if they do, they are much quicker taking enforcement action and a very aggressive creditor to have on your back. Yeah. There
isn't a public register for anybody using a payment plan with HMRC, is there? I don't think.
Yeah, it's a good question, actually. I think if there was, we would have discovered it by now. But
right, okay. Well, no, I know they publish a naughty boys list of who's been fined, so I've seen that on their website. So yeah, I've seen that, and it's always interesting as to the sectors that those companies exist in. So. Yeah,
there's a lot of petitions for sure, and a lot of them get cleared very quickly before they get advertised in the Gazette. And once it goes in the Gazette and it gets picked up, that's the danger then, that other creditors will piggyback on those. But if the petition comes in, you really got to clear it within 24-48 hours as quickly as you can, because once it goes public, I think then it kind of escalates out of control very quickly for companies.
Nice, fantastic. Does anybody have any questions for Shannon? I'm assuming not. Right. Thank you very much, Shannon. It's very, very much appreciated. Can I hand over to Barry from Aon, please?
Absolutely. How's everybody doing?
Superb. I think everybody's on mute though, Barry. So I think they've muted themselves. So
not a problem. It's the safest way to be, isn't it? Lots of cameras are turned off as well.
All good, thanks, Barry. All good.
Excellent, excellent. Thank you. Technology isn't really my thing. Can you see my slides, or do I need to press another button?
You need to share. So in the top right hand corner, you'll have there's a screen with an arrow pointing up. That's the one.
Oh, look at that. Technology. So hello everybody. I mean, I'm quite new to NASS. I have been to a few of the gatherings over the years, but you'd be more familiar with my colleague Mark Powell, I believe, who comes on and does his risk analysis piece quite regularly. Mark is unavoidably delayed or tied up today, so he's asked me to step in. So I'm going to do is just chat through Aon, our credit solutions business. We're all about delivering competitive advantage to clients, and that's all about growing trade, unlocking capital, and securing receivables. Now, what I want to do is I'll give you a brief introduction to myself, because most of you, well, pretty much all of you won't know me, even though I've been in the market for best part of 3 decades. I was schooled by the likes of Frank Hurst and Mel Wild back in the day. So I have been around, I've been involved in the sector and continue to be so, but from a more of a strategic level within our business these days. I'm going to touch through our market insight report and some of the stuff there. Quite conscious there's been lots of data and heavy slides so far, so I'm going to flip through them and then going to look at how we view the market in terms of what we call our convergence theory, and then the kind of the bunch of what I get involved in these days is working capital 360 and how we use insurance market capital to support our clients. So if we move along, this is me, Barry Watson. I'm the growth and innovation leader. Like I said, I've been in this market for 27 years now, coming up 28 years. I have worked across many different sectors. I work with clients in private equity, so I know all about the pressure points about ownership and concerns when private equity might be involved, leverage buyouts, employee ownership trusts, etc. And I also get involved in helping companies such as that to use the insurance market to support their capital and their liquidity requirements. So if we look at this first slide, it's again, this comes from our overview. It's a trade credit market overview. We produce this report twice a year. The current one is under draft. This one is H1 2024, and what we see, and this is something that's continuing echo what Shannon has been saying, we're not really seeing too many torpedo claims at the moment in the market. Following on from the COVID pandemic crisis and all of the drama that created for everybody, we did see a little bit of private equity movement into consolidation in the market, more employee trusts. And as Shannon mentioned, these are the companies that come under more scrutiny because it's a question of, have they got enough firepower to ride out the storm when the trading volumes are down? And with all the volatility in tariffs, it means that we need to look closely at the balance sheets, at the working capital, and how these companies are performing going forward. As we see there, the markets come back to kind of pre-pandemic levels in terms of their performances. And I think that the good news is that the markets are quite stable. The markets are generally working well, and the financials are perfectly fine for them. I think what you also have to bear in mind is it's a very competitive market these days, and there are somewhere in the region of 67 different insurers who write some form of credit, structured credit, political risk, and surety lines. So everything involved around supporting our trade globally. There's a lot of competition in that market, and the monolines are well and truly holding their own. But we do see increased competition and increased market entrants, such as MGAs, who will come into more specific kind of Lloyd's backed structures. Sorry, is my problems with my slide? Apologies.
I think if you hit page down, Barry, it'll go on to the next one. Page down on your keyboard.
Yes. Oh. Yeah. Good job you know how to work my machine.
Page down and page up.
Terrible. Terrible. So where are we with this one? Yeah, as we say, the insurers are very profitable. They continue to be so. The results might be impacted by volume flows, certainly when you're looking at the trade credit models, where we often see that policy will be written, as you know, with maybe 70, 80, 90% estimated premiums. And then we look for the true up at the end of the year on the success of the client's profitability, or certainly the client's turnover and performance for the year. But we seem to be seeing that, you know, everything is generally going in a positive direction. And that brings us to, you know, when we look at the volumes of trade being written. And I think Shannon mentioned earlier, there's a figure of around about 75% for risk appetite across the board. I think if we're looking at the metals sector on our data, and we've got a proprietary internal system called Trading Desk, where we get a live feed from the major carriers of every credit limit that is requested, and every credit limit that is agreed or not agreed by our markets. And we see quite consistent through the last years. There's been growth generally across the market. When we look at steel, if we look at it from December 24 to May 25, we're consistently running in the low to mid 70s in terms of limit approval. So what does that mean? That means that there's generally good appetite in the market. But what we are also seeing more and more these days is that where an insured client has not got sufficient capacity or support from their whole turnover carrier, then there are ways to bring other solutions into the play and to help clients maximize their use of credit insurance, and subject to whatever motivations they've got there, whether that's pure bad debt protection or whether it's to use a product to support their financing. Then this brings us into what we call our market convergence theory. And this is essentially, if we look at where the market was 10 years ago, maybe it's gone a little bit longer than that now, maybe it's 15, it's very, very common that people would have one credit insurance policy, one credit insurance partner, and that would cover the majority of their book. It used to be whole turnover, good old-fashioned, ground up, insure everything that we sell. There was always conversation around why would we insure blue chips, and people were quite commonly saying, well, we don't want to insure the blue chips, but then insurers' appetite would be looking at, you know, we're now being asked to be adversely selected against in terms of what we're going to write. But as the kind of world's evolved, people have realized that there's a price for different layers of risk, and there's a price for being able to maximize what people actually want the insurance to do. So as more competitions come in the market, more insurers have come in and said, you know what, that whole turnover model for me doesn't quite work. I prefer to look at a higher level of risk share, so I might come into the excess of loss. And that's where you've got your two portfolio plays, and the excess of loss has become named buyer. We can slice and dice any portfolio we wish to look at now, and that can be regional, it can be product, it can be group, it can be whatever we want to do with it. But also what we've done is we've seen this convergence of what would be the single risk market, which is really where, you know, if we're talking the home base of maybe 10, 12 portfolio markets, you've probably got another, you know, 50 insurers who will write it on a single basis, and they've got big lines of capacity for single contracts, and that can be single transaction, that can be long-term contract, and that can be anything 10, 15 years in duration. So in the convergence theory is where these two sides of the market are coming together, and it's allowing more creative structures to be put in place for clients in order to maximize what they're looking to achieve with their insurance program. How does this all work together? This is where you work with your broker to say, we've got needs that are not matched by the current solution that we've got. How can we bring other capacity players to our side to help us with the maximizing what we're trying to achieve? So that could be a top-up solution, that could be a syndicated solution, and what we're seeing more and more these days is it's not uncommon for the big three and the excess of loss carriers to actually work together on portfolios, which is something that we never used to see years ago. So you quite often now we will see very large contract exposures where some insurers have got either capacity constraints because they're just full on a name, and it's not particularly a poor risk, it's just they're actually full with their insurance treaties, etc. So we might bring 2, 3, and in some cases we're bringing 5 insurers together on a portfolio to make sure that we can get the credit limit and the policy limit to the levels that need to be in place. And this is all kind of falling back from how the Lloyd's market works on single contracts. And the theory here is very simple. If you can do it for a single contract, why can't you do it for a portfolio of contracts? And that's where we're having lots of success across various different sectors, including the steel sector as well. So it brings us around to our working capital 360 model. And this is, again, really the kind of focus on what I do day to day, working with clients. And this can be clients who are private equity backed. This can be employee ownership trust. This can be any client whatsoever. What we're looking to talk about here and what we're looking to establish is how the market can support you truly in what you're looking to achieve and what your direction of travel is as a business for your strategy, not for just today, not just for tomorrow, but we're looking at 3 to 5 year plans to make sure that your working capital and your credit insurance solution is absolutely robust to help you deliver to where you need to be. I think the first thing that I look at here, and I know that Shannon was mentioning about risk ratings and metals being a sensitive sector. The first thing we will do with a client is we will actually look at the client as a risk. Quite often we find that when we're talking about credit insurance, we're really focusing on the receivable book, which is obviously the genesis of the product. But sometimes people take their eye off, where do I sit in the ecosystem with my supply base? And how do my peers view me? How does the credit insurance market view me? And is there anything I can do to improve the perception of me as a credit risk? Because sometimes, and bless, we can only work on the information we've got. And if a risk analysis is only being taken on a set of financial reports, and this again goes back to Shannon's point where we've got regular risk meetings with companies and we ask for more updated information. But if you haven't got that connection with the market, and quite a few companies don't, then it's quite easy that you might fall down the kind of the grey area, and the view of you might be a lower risk rating than your business actually warrants. In which case, what we would do is we would help you to navigate the market. We would help you basically present your business to the market in a way that the underwriters can say, yes, you know what, we've seen your annual numbers, we've seen some management numbers, but actually now we're understanding the direction of travel, the plan, the strategy, the funding. And this is really key where you've had a change of ownership. This is really key if you're going to have a change of ownership. So let's have the conversation before the event. And this is very key if you're subject to much M&A activity as well. So it's all about making sure that we get you into the best possible place you can be in terms of the perception of you as a credit risk, in order that your suppliers and future suppliers can obtain as much cover on you as they require, but also so you can use the cover strategically should you be looking to enter into a large contract and you might need some additional supplies. or maybe it's even you're looking to target an acquisition and you want to use credit insurance to support some kind of deferred consideration structure in the transaction. So from there, we work with a client to look at bringing the money into the business, which is your trade receivables. As you're all very familiar, and a lot of you use credit insurance, more and more you'll be aware that these products are being very well accepted by financiers, be it traditional mainstream banks, be it non-banking financial institutions, where they're looking to buy receivables, provide receivable purchase, receivable finance programs. And if we use the insurance correctly and we write the policy wordings so that they match the requirements required internally by these institutions, then that should be able to provide you with a knock-on benefit of cheaper cost of funding, better advance rates, and overall better optimized finance facility, which obviously helps with a working capital of the business. So the two items there, if we can secure more capacity on you, improve your risk grade so you are getting more insurance capacity, more open account terms from your suppliers, that helps you keep money in the business longer. And if we can get the trade receivables converted to cash quicker, that puts more money into the business. That's improving your free cash flow. So straight away, you've ticked two boxes and puts you in a better financial position when people are looking to you to offer credit, offer you supplies. And from there, we move into an area which is collateral replacement. And collateral replacement is really around where you're using the bank to issue bank guarantees to support your contractual obligations. This can be pretty much any contractual obligation you might have. Anything the bank can do, in theory, the insurance market can replicate and provide you with an alternative solution or a complementary solution. And we're talking here surety bonds. So if you've got to provide collateral for Digital Markets Act, where you've got to ring fence client monies, for example, then you can use a surety to protect those client monies. Where you're importing and exporting goods, if there are any duty deferment requirements, if you're using non-conventional insurance structures and you're looking for a surety placement or some form of guarantee being issued to the fronting insurer, then we can replace that guarantee with a surety bond. And the thing here about how this affects working capital is typically when you use your bank facility, you're drawing down against your bank line, so you're tying up your bank facilities. If we use the insurance market for this, the surety market, then you're not tying up your bank lines. These are facilities that sit by the side. They're contingent liabilities, not liabilities on the balance sheet. And they really do provide a very good complementary, as I say, or alternative solution. And they're usually very cost effective against bank pricing as well. So that's the three areas what we're looking at. Again, just to reiterate, trade payables is you as a risk. The trade receivables is getting the money in quicker. Replacement of collateral is freeing up any collateral you've got tied up. And that all improves the working capital and liquidity position of the business. And then we move into the fourth and final part of the 360, because obviously you need four parts of the wheel to 360 degrees. And this is where you've got investments and operations overseas, where there was a comment earlier made by Shannon again, and I'm referencing you quite a lot, Shannon, so thank you. It was a good segue into my presentation, is political risk. And we're seeing more and more inquiries at the moment for areas where traditionally we wouldn't see people coming to the market asking for political risk, certainly over the last 20 years, because we've had such a benign environment. Now we're seeing people coming to the market and say, we're investing in the Baltics. Should we be considering political risk cover over our investment? And what does this mean? This means that you're going to set up a facility, an operation, a business. You're going to put equity and debt into the structure. You're going to be providing intercompany loans, etc. What happens if we go to hell in a handcart and you can't get access, you can't recover, you can't get the beneficial ownership interest in those assets because of political intervention, war, violence, whatever might be the overspill potentially from the Russian-Ukraine conflict? We don't know the answers to those questions, but there are ways to mitigate the risks. And if we do that successfully, then it would protect your balance sheet, protect the business, protect your liquidity forever what comes forward. And you know, I don't think we really know, any of us know what's going to come forward at the moment. So it's a bit of a crystal ball. So the journey for all this is literally, how do we get there? How do we look at these different working capital items, and how do we pull them together and make it all work? Well, it's a journey. It doesn't just happen overnight. It's all about how we interact with you, how we work with clients to really get to understand the business, how we put a support team around any project and interaction that we've got. We get as many facts as we can together, understand your motivations, your plans, your strategy, where do you want to be in that next 5 years. We evaluate how we can get there, and then we design a solution to get you there. And then we set about putting those building blocks in place to get you there to meet your objectives and your plans. And then with that, you've got a robust program, improved working capital, and leveraging the insurance market to support your business. And with that, conscious I've gone very quick through all of this, thank you very much. And has anybody got any questions?
Anybody have any questions? No. Fantastic. So Barry, you must have done a good job, as Shannon did. Yeah. So thank you.
Everyone's gone to sleep.
No. So I'd like to thank everybody for attending. I'd like to thank the three presenters, Michael, Barry, and Shannon. Thank you for your time. Thank you for coming on and sharing the information that you have, and the information for everybody. I hope everybody found it useful. So thank you very much. Cheers.
Thank you. Bye-bye.
Thank you.
Yeah, obviously all of
Thank you so much. Thank you. Bye.
Thank you. Bye-bye.
All the details will be shared with Claire. So anybody who wants any information, let her know. Cheers.
Thanks, Ian.